Hello everyone, welcome to TechMind Investing, where logic meets the market. In the capital market, valuations often reflect investors' expectations for the future. But recently, something rather counterintuitive has been happening. Nvidia, the company leading the global wave of artificial intelligence, now has a forward PE ratio lower than Costco, the iconic symbol of retail stability. According to traditional market logic, high growth and high profit tech companies should command higher valuations, while mature retail businesses with slower growth typically deserve more modest multiples. Yet today, the opposite is happening, making this situation especially intriguing. To understand whether this valuation inversion makes sense, let's start with the numbers, because numbers reveal truth before opinions do. Nvidia's latest financial results show that in fiscal Q3 of 2026, the company reported $57 billion in revenue, a stunning 62% year-over-year increase. Its gross margin exceeds 70%, and its net margin sits comfortably above 50%, making Nvidia one of the most profitable large companies in the world. Its capital efficiency is equally impressive. ROE has surpassed 100%, reflecting exceptional returns on shareholder capital. Looking ahead, Nvidia's revenue is expected to grow at a compound annual rate of nearly 27%, and EPS around 28% over the next 5 years. This isn't just high growth today, it is durable, long-term expansion powered by structural demand for AI compute. Now let's look at Costco. The company's revenue is enormous, over $250 billion in fiscal 2024, but its annual growth rate is only around 5%. Its gross margin hovers near 12% and net margin around 3%. Looking forward, Costco's revenue CAGR is expected to be just 6.7%, and its EPS growth remains in the single digits. In other words, Costco is stable and reliable, but its growth ceiling is very clear. Compared with Nvidia, the difference is dramatic. Nvidia's growth rate is 3 to 4 times higher, and its profitability is more than 10 times stronger. Yet, despite this contrast, Nvidia trades at about 25x forward earnings, while Costco trades above 40x. From a purely numerical perspective, the market is paying a higher price for Costco's future earnings, a situation that seems difficult to justify. Now that we've seen the numbers, it becomes easier to understand the deeper contradiction when we look at the business nature of both companies. Nvidia is a deep tech company at the center of the AI era. It provides the compute foundation for large-scale model training, cloud computing, autonomous driving, and scientific simulation. Its business model thrives in an environment of rapid technological advancement, high demand, and strong competitive moats. Nvidia represents the future. Costco represents stability. It relies on low prices, high turnover, and a very sticky membership model to generate consistent, predictable profits. Its growth doesn't depend on technological breakthroughs, it depends on disciplined execution and scale. Costco isn't built for explosive growth, it's built for dependable, repeatable success. Under normal circumstances, these two companies should be valued through completely different lenses. Yet the current market is assigning the higher valuation to the company with lower growth and lower profitability. Costco's high valuation comes from the market's extreme preference for stability. Membership revenue provides predictable cash flow. Economic cycles have minimal impact on its performance. Renewal rates consistently exceed 90%, giving Costco the stability of a fixed income-like asset. In a world filled with uncertainty, institutional capital naturally gravitates toward low volatility businesses. Costco becomes the safe harbor. Nvidia, despite its extraordinary growth, faces its own risks. Rapid expansion leads investors to fear eventual slowdown. Competitive threats from AMD to custom accelerators are amplified by the market. And policy risks, especially US export controls on high-end GPUs, create genuine uncertainty. These concerns make investors cautious when assigning valuations to high-growth companies. This creates a split valuation logic. High-growth businesses are priced for uncertainty. Stable businesses are priced for predictability. In a risk-averse environment, predictability wins, at least temporarily. But from a long-term perspective, this situation is fundamentally irrational and unsustainable. Short-term valuations may be driven by sentiment, but long-term valuations are anchored in growth and profitability. Costco is steady, but its growth ceiling is fixed. Nvidia stands at the center of a multi-industry technological transformation. AI, compute demand, and digitalization across fields form a structural growth cycle expected to last a decade or more. Companies with strong growth, high profits, and exceptional efficiency eventually regain the valuation premium they deserve. This means today's valuation mismatch is far more likely a temporary distortion rather than a rational, long-term equilibrium. As external risks diminish and investor sentiment shifts back toward growth, valuations will realign. Nvidia is undervalued today, and Costco is overvalued, and this imbalance is unlikely to persist over long time horizons. So if you had $10,000 and could only choose one company for the long term, would you pick Nvidia, the high growth, high profit engine of the AI era, or Costco, the steady but richly valued retail giant? Do you believe the market is overestimating the risks surrounding Nvidia? Share your thoughts in the comments below. Let's explore the logic and long-term trends behind this valuation puzzle together. And if you enjoy this kind of deep analysis, feel free to subscribe and like the video. Your support helps us bring more high-quality investing content here on TechMine Investing.